Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor attempts to capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example, consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from this same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock. The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise. This investor considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now, let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks that the stock price will not increase much over the next few months. Both investors can utilize a call option. This type of option contract gives the buyer the right to buy shares of Stone Curb stock at a set price, called a strike price, at a set time, called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer purchases the contract by paying the option's premium. The premium, or price of the option, is determined by several factors, including the stock price, time until expiration, and implied volatility, which is how much the stock is expected to move during the life of the contract. This premium gets credited to the seller of the call option and helps to partially offset the original purchase price of the stock. For this example, let's assume the total premium is $100. Our buyer pays the $100 and purchases the contract. Now, let's examine what could happen to this investment. Suppose our buyer's instincts were right, and Stone Curb stock is now selling at $60 a share. Remember, the call option gives the buyer the right to purchase shares of this stock for $55 a share. The buyer could exercise the call and purchase 100 shares for $55 each, and then sell them at market value for $60 each, making a profit of $5 per share, not including commissions. Because shares of Stone Curb have risen by $5, the buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit, the value of her contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out as well for the seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's appreciation because he was obligated to sell his stock at $55 per share. Now, let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share on the last trading day prior to expiration. The buyer's contract gives her the right to purchase shares of Stone Curb for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45 in the open market, the buyer's contract will likely expire worthless. The buyer is now on track to lose 100% of her initial $100 investment, plus any trading commissions and fees. For the seller, the option expiring worthless is good news. He still owns his shares of stock and made $100 selling the option. Although the value of his shares declined, he was able to keep the option premium, less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the underlying instrument that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options, which we just saw, that can be profitable to own if the price of a stock goes up. And then there are put options, which can be profitable to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction and create strategies with a variety of risk levels. You've taken the first step in understanding options. Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments: stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks, but that's just the beginning.